And now I'm in the Dow, and I'm in the Dow, and I'm thinking, okay, we might see some cool down in the economy, like real cool down is finally coming in. And people might say in that situation, all right, maybe we go into, if yields are falling dramatically, dividend stocks are going to look as an opportunity cost a little bit more attractive. That's my opinion on this. If I'm wrong, I will stop out again. I'm holding loosely to strong opinions. That's been the theme recently, holding loosely to strong opinions in this market. That is the name of the game for me. The VIX is up 6% today. If this market tells me I'm wrong, I'm out, right? I'm not sticking around holding the bag. I'm not a buy and hold investor. I am a trader, and trading means admitting when you're wrong quickly and trying to make it work when it's right. So that's what we're going to do. Just a heads up, I mentioned this earlier. If you guys want to get access to the Edge Finder, we're doing a 55% off discount for people watching the stream right now. Get yourself a copy. I'm telling you, it is the lowest. You want to talk about discounts in the market right now? This is the best one on the possible list of discounts. You got 55% off. Do you guys know what a 55% discount looks like? Hold on. Let me show you what a discount of 55% looks like. Let's see. Is this 55%? This is a visual representation. Wow, that actually worked out perfectly. This is a visual representation of a 55% discount like we're seeing on Tesla. But Tesla might not be a great buy here, but I can tell you with very strong probabilities that a 55% discount on the Edge Finder is a wonderful buy the dip opportunity. It is a low cost right now. It is our best price of the year. Despite my jokes and my silliness, it is genuinely a really great tool that we put a lot of effort in. We're constantly improving it. By buying a copy, you pay one time. It is not a recurring fee, and you get access to all of our data and ideas throughout. All of our updates and features come to you for free. So it's a great investment if you're looking to get some more market data. Again, this is your chance. Probably the best pullback discount available on the screens right now. So check it out. We'll drop the link here in the chat. With this link, when you click that, you can speak directly to a member of our team and get access to the Edge Finder, 55% off. Don't miss it. Real quick, we're going to take a break, and then I'm going to toss the show over to our next host, Chris Pulver, to take a look at markets, take a look at charts, and I am sure he's got a lot of opinions here today with everything selling off. Maybe he'll be joined by Frank shortly after to take on this craziness as we get closer into earnings season. Dow's the only thing hanging in there. Russell's hanging in there. I know Chris might be having a decent day. I don't know. He's probably having a better day than me, tell you that much. Anyways, stay tuned. We'll be right back with Chris just after this. Man, Frank, we finally made it down to the beach this year. What do you think?
I think this is a really great setup.
No, Frank, we're at the beach. We came all the way down here. What are you doing on your phone?
But check this out. It's a really great setup on gold right here.
Our Edge Finder summer sale is now live. Get 50% off all of our tools like Commitment of Traders data, economic data, and our top setups algorithm for 50+% off using the link being dropped in the chat right now or the description down below. Don't miss it. This is our biggest sale of the entire year.
Hey everybody, happy Thursday. This market is very interesting to say the least. I just had a couple of trades close up for profit, which I'm super happy with. One of those was a short-term trade on the SPX. I did my little daily situation. We had 54. So when the market opened right here around 54.25, I went ahead and sold my call and I sold my put. I collected $3.80 credit. And it closed out for a quick $3.20 debit. So I took my plus 60 cents. Very mechanical. Take the trade, grab a 15% take profit. Works out pretty nicely. I'm putting that in my tracker right now. So that's a 7:25 expiration. So 0 DTE. I sent it around 54.25. And let me go into my platform and see what the legs were. So on the SPX trade, I know the numbers might be small, but bear with me. We can see my screen. Yep. Okay. So there, if you can see this over here, this is my 380. There's my 320. So there's my difference in the trade. And the nice thing is now that trade actually would be upside down a little bit because we've had a slight directional push in the first, it's been about 45 minutes since the open, but all I needed was that quick theta decay for the first like 15, 20 minutes of trading this morning. So As it stands right now, nice little win. I'll take it. And also, the one that makes me really happy this morning is a win on NVIDIA. I'll tell you that in a second. So, not a bad trade overall. Hanging in there. Also closed out some trades on the VIX. The VIX is up to 18 plus. I wasn't real pleased to see that my intrinsic value on my call options were not paying out the way that they should. So what I was looking at is I'm at a 10.50 call on the VIX and it's trading at 18 and change. That should be a $7.50 call. Instead, it was trading for like 650, 640. That's where I closed it out today. It was just $6 and change. So I did net around $1,300 on the VIX this morning per account here, which is pretty nice. And also took some profit on NVIDIA. So let me just get this tracked in. I sold the 5370. So this is, I'm just going to add this in, 5370 and then the 5470. The credit was pretty solid there, $3.80, one of the better credits I've seen the last month or so. And then 3.20 was my take profit, hit that level, 60 cents. That was a nice little win. And that is a quick win, closed by 9:55 a.m. Eastern time. Okay. So if I take a look at this trade right now, it's trading for about 3.95. So I'd be upside down about 10 or 15 cents if I was still hanging on to it. I mean, it's still inside. This is what's nice about the trade. It's still inside my level. So, this would be my sell put, and up here is going to be my sell call. But you can see that the call side is now further stretched because price has been going lower. So when the put side is threatened or the call side is threatened, it will change. But you can see here, like, there's a lot of fluctuation there for 10, 15, 20 cents. I mean, it was up to 3.95. Now it's under 3.50. So just like that, this trade is, back in profit now. And I'm sure as another maybe 15 to 30 minutes goes by, this will be back down towards 310, 305, grabbing some quick profit out of that trade. So overall, pretty decent day. Maybe it's noisy, maybe it's directional. Doesn't really matter. The trade's over. I'm happy with that. What I do on NVIDIA, let's talk about some stocks. Let's get some comments in here. Where are we at? What kind of trade was that? I call it the daily bread trade. That's what I call it because I'm in it almost every day. And it's really something I take for maybe 60 minutes or so, 60 to 90 minutes. And usually it's a winner. I mean, over the last couple of months, I'm averaging around 90% on those trades for wins. And I managed to trade fairly early. So even by, if I'm not right, I'm not taking full losses. I'm usually taking, manageable losses of, I don't know, if I lose like $150 to $200, but on the average, I'm gaining like $60 to $70. But a 90+% win rate is pretty nice. And, it adds up. I mean, it's an extra little income play for the week, adds to my bottom line. And, yeah, so I like it. It can be. So Juan, you sound like you're in a perfect position to, stay in touch with me and talk more about that. Cause I do have, all the information and mechanics on that trade. So, all right. Also, we have some crazy stuff going on today. The Japanese yen is all friggin' over the place. So I'm not sure how Nick has been doing on the trading battle this week. I've been all over the place trying to get in and out, trying to do some pairs trading on the yen crosses. They have literally been one winner, one loser all week. So Bitcoin, Ethereum, one winner, one loser. All the yen crosses, one winner, one loser. My net position on the battle for this week, I'm up about $527. I'm heading out of town today. I would put on some other trades, but I'm like, I don't know. Nick, you need to let me know how you're doing on the battle. If I'm down and I'm behind, then I'm going to try to throw in something and maybe do a Hail Mary to grab some profit. But I'm sitting up about $500. I was up $850 at the peak right after our first day of trading. And just the yens have been wild enough that I got beat up a little bit where the losses were getting hit. And then I was just shy of those profits and I'm kind of washing trades. And anyway, it's been a frustrating week for just having that high volatility. I mean, this is a wild and crazy day. Like we dropped all the way back down, popped all the way back up. I was also doing the same thing in crypto. So it's been pretty wild. I did, however, if anybody's interested, I started to get myself into some of these Swiss crosses again. Now, I have been in the Swiss for a long time. This is an FX chart. So I opened this account with Tasty FX, and I'm going to use this primarily for robot trading. So I have, robots running with Oanda. I've got discretionary accounts and copy services running with Oanda. But TastyFX, because I work so closely with them in my stock options and futures account, I'm doing TastyFX as well. So Tasty Trade is my, stocks, options, ETFs, futures, even crypto broker, which they're great and they're easy to chat with. Plat Tech is great. Support's awesome. But anyway, I opened this account up with 20K, and I just thought I like these Swiss pairs enough. I'm just going to take some more stabs at them. And so I'm in Aussie Swiss and New Zealand Swiss, and I'm also pending orders. Let me see here if I've got pending. Where is there it is. Pending on Euro Swiss and pending on Dollar Swiss. So I like some of these Swiss pairs enough. I'm just going to, kind of juice those profits. There's been some inefficiencies on the way down. So if you look at something like the Euro Swiss, I want to kind of buy it now and go after that little pocket. But I'm just going to go ahead and throw one in down here instead. And then recently we had such an underperformance on the Aussie Swiss. So Aussie Swiss has dropped a decent amount. This one I have a trade in going right back to that pocket and right back to that pocket. So if these are profitable, this will be up about 100 pips. This will be up about 300 pips. I'll take my profit there. So 100, 300, so about 400 pips total, and grab a quick little kind of a pocket scalp, if you will, on the Aussie Swiss. And the New Zealand Swiss, same type of thing. This one is, sitting here near 30-year lows, and over the last 2 weeks has dropped pretty aggressively. I am just going to look at pulling back into some type of, stabilizing whenever it's ready. I can't force this trade, but whenever it's ready, trying to come back into a pocket, little efficiency trade. And I'm also going down to take maybe a 5,000 trade as well, and see that one get to an even bigger profit. So that 5,000 order right here, same profit target. So if I get that trade about 100 pips, that trade should be about 300 pips. So they're pretty similar looks, but each one's going to net me about 500 bucks. And so if I have another, 500 bucks on this account for the New Zealand Swiss, another 500 bucks on the Aussie Swiss, I get maybe a bigger trade position that I want to add to on the Dollar Swiss, Euro Swiss. These are the type of trades that I like them enough. If I follow them closely enough and keep the trade size respectable, I add to my winning trades. I can take this, $20,000 account, probably turn this into like 30 grand, maybe more if I try to double this account. I've got another account that's doing the exact same thing. It is a $20,000 account. I'm trying to double it. It's not that hard. I just, there's a lot of entries. They're all super, super small. I'm trading a lot of nano lots on my Oanda accounts, but I'm building into those, kind of micro lots and mini lots and standard lots. So Nick says you're definitely beating me in the battle. Oh, okay. All right. Well, it's been a wild week, dude. It really has. And the nice thing that I have running here on my side is, I mean, look, I'm somehow carving out, 2,000 bucks in the day. The portfolio is still up. I'm not at all-time highs. I've shrugged off about $40,000-$50,000 in the last couple weeks. But I mean, P&L is not just dumping. I've got some hedges. I've got some positions. My broken wing butterflies will be profitable. So all this it's fine. It is what it is, right? I mean, the nice thing is we've talked about this for the last several weeks, that I couldn't just think that this narrow, highly concentrated Mag 7 market is going to be the one thing that keeps going up. There's going to have to be a broadening. There's going to have to be a mass strengthening in the market, or there's going to have to be a top. And what we're experiencing right now is there's a top, right? So how severe is the top? We're going to find out, because if we look at the SPX, from a percentage, actually, you know what? Now that we're talking about this, I was going to have this reserved for my trading room here in the next 45 minutes or so. But let's talk about it. So I don't know if I'm going to get filled on this, but I'm going to put in a position here on the Qs, because I do think there's a good opportunity to be long. Now, what I will do is I'm going to trade options. And you can, if you're a options trader, if you have options permissions, you can do credit spreads. This is an easy way to take the trade. I was looking at a 10 to 15%. Okay, 10 to 15% correction on the QQQ. We've had about an 8% correction from top to bottom right now. 9.56 correction. Now, that's right around that 10% level I've been talking about. So can I get, for a 450 credit spread, let me see what this does on the QQQ. So I have ratio spreads out there. Let me check my positions on my Qs right now. So Qs, I have a naked put out to 364, which is way out of the way. On my NQ, which is a futures trade, I have a it's considered, it's called a 111. That's a really, popular name for the strategy. But basically what it is it's a bear put spread combined with a put in order to, it's kind of like a more advanced ratio spread. And the reason why is you can define the risk. You don't have to overpay for the long put. You can spread that, have it be a really nice hedge, and then also have your put. So year to date wise, P&L, let me see if it shows up here. So my NQ is down a little bit, but the 19.2 and the 19.1, that trade all by itself, going out to August. Okay, I mean, this trade cost me next to nothing, right? I mean, current price. So here's my 19.2, 19.1. I'm actually in profit. If we stay here, by the way, okay, if we stay here on the Qs and go down, that is a hedge of about, well, it's about a $5,000 hedge. Okay, it's about a $5,000 hedge in profit. Now, on top of that, I also have a put that's way, way, way down here, out of the way, and that's another like couple $1,000. So it's a position for me that I can go, all right, price is right here. I will protect myself with a debit spread, and then also collect some more income on a very low probability threatening position. So if price goes up, I still make money on the trade. I collected $10.50 or $9.50 credit. If price goes down, okay, go down a little bit, I still make some money. Go down through my bear put spread, I make some money. Go down enough. I mean, I don't really want to see my naked put get threatened, obviously. And I will have to manage that. But usually, if we're already discounting this at, okay, I'm safe until this market crashes like 10%, 15%, 20%. That's how you can construct this trade. So pretty cool. Anyway, let me take a look at the Qs. I'm going to put in a trade, and I don't know if this is going to get filled, but I'm going to do a 450 and see if this, I mean, the IV on the QQQ is going to be around 60 something right now. So here's a 66 IV rank. If I went out, let's say, realistically, I'm kind of interested in staggering. So I might go October, November, December on the Qs. October gets us into Q4, November gets us in the election. Realistically, I think going into November, December is probably better, just to stagger out a little bit of income. Now, I don't know if I'm going to get filled on the trade. I'm going to put them in as pending orders and see if the broker will fill me, right? So they may not get filled today. I want to get filled at the price levels I'm interested in. And so what I'm going to do is this. We're at 450. And if I have anybody in this session that is in my Equities on Demand trading room, we'll talk about this in the next 45 minutes or so. I am going to take this trade. We'll post it in the tracker, but I like this trade a lot. So 450, and then down here again around 420. Okay, so 450. If I go out to November 15th to a 450, that is going to be my put. Okay, so right now for a $5 spread, I can collect $1.60. Now that's about a third of the width, which is okay, but I'm not really happy with that trade. If I have $1.60 out of a $5 spread, I'm collecting about 1/3 the width. Now, from a tasty trade philosophy, that's pretty good. For me personally, if we're going to drop a little bit farther, I think we can get $2 to $2.50. So what I'm going to do is put in a trade here for about $2 and fudge it. I'll just go 250. I'll just try to take essentially an at the money. So let me check one thing. If I did an at the money, we're at 460 right now. An at the money is trading for $1.95. Well, that just shows me I probably can't get 250 on the trade. So let's try $2. I'll do a 450 by 445 for $2, and I will take 2 contracts. So it's not going to take right now. It's going to be pending. But if price is going to threaten this low or go a little bit lower, I should be able to get filled at $2. Now, for me, time is on my side. So if I take the trade here at the 450 by 445, if we are up higher than that into November, that's going to be full credit on the trade. Okay. If I want to take a profit target on that, I can go after like a 50% take profit or better. Usually when I'm doing credit spreads, I typically manage 0. I don't manage it at all. I let it go to expiration, or I try to take profit when it's good enough around 80+%. So if my credit is, $2 and I'm at, 80% of that move, what would that be? So what's my 80% move? Should be, so $2. So I take $1.60 out of it. So if I see a $2 credit turn into a 40-cent debit, I can take that $1.60, move on, be more capital efficient, and deploy it elsewhere. Okay, but I like the trade. I'm gonna see if I get filled. So I'd like to get filled at 250. But what I'm looking at right now is at the money. The broker's only going to feel about $2 right now at the money, and so I think I'm going to try to take the 250 trade or the $2 trade. So $2, 2 contracts. Let me put this in for all of my accounts here. So that'll be pending. That's pending. All right. So let's work that order now. So similar. Delete all my scribbles. Okay. Next account. Let's go. There we are. Pending. Pending. Okay. 9151. And 8051. Okay. So all pending there at $2. Now that's trade one. So I'm going to put in a 450 by 445. Okay. And then I'm going to do one more trade, and that's pending. I'm going to do one more trade down here at these April lows, the 416. So I'll do a 420 and do a same trade. So November 420 by 415, and do the same thing here for $2. $2 for 2 contracts, and do the exact same thing. So there. This one, yeah, I mean, whatever. It's a half of one, it's like a 1/4% risk. But I like the trade, so I'll put the same thing here. All right, so net credit $2, max profit 400, max loss 600. Pretty black and white trade, and send. So similar 9732. There we go. Okay. Just getting all these orders placed. 9151. And here. And here. Okay. All right. Good. All right. So those are in. Now I'm going to go out to December and do the same thing. Now let me get some questions. Expecting on gold. Gold's totally choppy today. Better wait for a target. Okay. Let's do this. Let's go to December's expiration now. I'm going to do the same thing on the Qs. Now I'll go out to the end of the year, December 31st. Yeah. Same trades. So the 450. Now it's interesting. December 31st, I can do the 450 by 449, and I'll take the same leg on the trade. So is this one at 450 by 449? I think what I'll do on this one is by December, where are we? I mean, I think we're still going to be higher. I think that the bull market is still very much intact. I mean, if you take a look at my chart on the Qs, what I see is we have just been going up, very steeply, where, we break these aggressive trend lines, pull back to an outer, go up and, break an inner, find support. I mean, I don't know. I'm looking to find support. So this past resistance to me is a logical spot to get a bounce. In the short term, I could also just buy shares and, trade it that way. I could do a buy right if I'm trading options, but I trade a lot of options to preserve my buying power and have cash at the ready. I'm a little excited that there's been a 9.5% discount on the Qs. I think it was needed, and it also has accelerated more than what we had back in April. That April correction from top to bottom was around 8%, and this has been one of the worst sell-offs we've seen since I don't know. I read yesterday like one of the worst days since like October 2022, but for the Nasdaq, one of the worst days since like 2002 or something awful like that. So it's been a pretty nasty spill from Wednesday or from Tuesday to Wednesday. That was a pretty awful day. Just in a single day from close on Tuesday, open to push on Wednesday. I mean, that was a that was an 18, almost $19 move just from covering the distance. That was about a 3.5 or a 3 to 3/4% sell off. So, Frank,
What's up, Chris?
man, what's up, dude? How are you?
Pretty good.
Good.
How's it going? How's the trading battle going?
Trading battle, I think, is going okay. I've given back a few profits. I was up to like $10,800. Had a couple of Japanese yen pairs beat me up a little bit, so I'm at 10.5 right now. I might be I don't know. I might be throwing it in for today. I'm heading out here in a couple hours to fly to California, so that might be my final effort on the trading battle is pulling out about $530 for charity. So hope
Cool.
that's enough. Goes to a good cause. Whether it's Nick wins, I wins, is all going to a good cause. But interesting week, man. I mean, it was. I didn't feel like having a single direction. I want to be on both sides of it, so I was just trying to manage those like bigger winners and losses. And sometimes it was just tough because price was right in the middle. Like I'm not hitting my stop loss, but I'm not hitting my take profit. They're both equally shitty, terrible. And so
Yeah.
I just watched a couple of trades, and but I was trading a lot of yens this week, a lot of yens, and then Bitcoin, Ethereum a couple of times. So what is fine. I mean, $500 is $500, but I'll see. So, how's your week, man?
Yeah. It's been fine. It's working out a little bit better this week on the short side.
Okay.
On the short side of things.
Yeah.
I have that SPX call or the bear put spread on
SVIX.
yeah.
Okay.
So I did it like I guess a few weeks back and it hasn't really moved and it kind of went against me for a little. But I bought a put at 50.5 and I sold a put at 40. And that was
Okay.
338 for the cost of that trade.
Okay. So you had a 338 debit. What's your credit showing right now? That's a pretty good move, dude.
It's at 688.
Yeah, there you go. Dude, take that
So
freaking profit, man. What are you waiting for? When's it expire?
August 30th.
Oh. I mean, you want more downside? You already got it trapped at 40, right?
Yeah.
I mean,
So
dude, if that's my trade, Frank, I'm taking that profit ASAP.
I think that's what I need help with is
Okay.
figuring out when to get out.
Now.
Um,
So here's why, right? Like I think that so what are the legs again? You're at a 52 by 40?
50.5
50.5. Okay.
by
50.5.
40.
Okay. So let's go 50.5 by 40. 338 debit, now showing for a 688 credit. Your max profit would be 1050 at expiration, which right now for just considering the time, you said August 30th.
Right.
So right now it's like your max profit's 1050. You're up about 60% of that trade, and you could save yourself a month of time and take that profit, redeploy that capital. So for $6.88, which is out of a 1050 max, you're already at a 65% take profit within a week or two, right?
So the problem with SVIX is that their spreads are really bad. I just
Yeah.
discovered that.
Which is probably why, I mean, and again, I was going to say like, how liquid is this fill? Because if you can't get filled to the mid price, that's
It's
going to be
not.
tough. So I'm
Yeah.
assuming that you're, well, let me look at it. So you're 50, let's go SVIX. I don't even have the instrument, bro. Well, that's unusual. Usually Tasty is a plethora of instruments, and I don't have it. So looks like that's all you, man. Crap.
Yeah.
All right. So give me the bid mid ask then, because I'm sure it's awful from what it sounds like.
It was 4, then 688, and then like 9 something.
If you again, you're in the debit for 338. I would try to get filled at a 638 or a 650. Like take it under the mid price, but if there's enough liquidity there, you can probably get filled under the mid. I don't want to take the bid price. That's a terrible fill. But if it's showing
Yeah.
a mid at six and change, 688, try to take a 675, try to take a 665, 655, 650. That's still a really good win, dude. That's over $3. I mean, you're looking at 100% gain on that position. That's pretty good.
Thanks. I also got a VIX vertical. So I did a bull call vertical in the VIX,
Okay.
which Tasty should have, right?
They do have VIX. I closed out my VIX today. I'm happy that I did. I think I expressed it this week. I was really disappointed to see that my VIX trade was not paying me intrinsic and extrinsic value. Travel blog. Whose Discord are you looking for? You looking for A1 Trading? I think they'll post that here. If you're looking for my Discord, let me know. Just ask for mine. I'll post it before I leave today. Okay, so my VIX positions, I have 2 of them, and I've closed them all out. Let me verify that. Yes. So I'll summarize this. So I had a 1050 call, and it was just a long call. And then I had a $20 long call. So I didn't have a spread on this at all. And when I noticed, like this week, I mean, price has been up to 17, 17.50, $18. We're still at 18 and change right now. This is what frustrated me a little bit. So we're trading at 18.30 current price. That means that my 1050, okay, my 1050 call should, and this is like out to August, and one was out to October, one is out to August, but my 1050 call, and we're trading at 18.30, I should be seeing like $7.80 of actual value in that call option. I closed it out today for 635. It was up to as high as like 670, 660 this morning. The VIX kind of faded a little bit off those highs. So really sensitive, but I just looked at it like, well, if we're about to put in a near-term bottom with the Qs down nearly 10%, the S&P down, 5 or 6%, I just think that it's been a pretty good smash to the downside. VIX is a very quick instrument to revert. And so I've got some profit. I'm going to go ahead and take it. So what I did is I had a 635 credit, and it was originally a 450 debit. So there's my $1.85. I was in for 5 contracts, so I made about $1,000 there. And then in my $20 call, was out of the money, and it was really cheap. I only paid $1.66, and I closed it today for $2.31. So 65 cents, and that was on 600
That's really
contracts.
good. What
Yeah, so
did it expire, or does it expire in like a month or something?
it does. They were, so one of them was August 21st, and the other one is October 16th. So there, I mean, I thought, well, if I'm going to really hedge this market, I need to be out to like August, September. But if we're getting kind of the early bird sell-off, and I don't know, like, is it going to get worse? It could. Who knows? But I think that, the same thing that Nick and I talked about yesterday on the show, the one thing that saved this market back in April and May was large cap tech in the Mag 7. And I know that so far, like, Google's not been great. Tesla's been disappointing. Netflix has been okay, but price action has not been great. So if we still have Apple, we still have Microsoft, right? We still have NVIDIA, which, by the way, is down. And I closed out NVIDIA today, and I'm super pumped about that. I'll talk about that in a second. I didn't think NVIDIA was going to be a profitable trade, and it turned out to give me $3. So I'm happy with that. But
Nice.
anyway, I thought if this is going to happen and we have kind of the same lineup of like, okay, earnings haven't been bad, but the market's taken everything really roughly. We've got, maybe it's the the sign of the consumer pulling back, and forward guidance is less. I saw the GDP print today was pretty interesting and bullish. So anyway, my point is, we've had a decent correction in July. Percentage wise, are we going to keep going? I mean, these are positive drift markets. And I know that everyone's like, oh, this is the bear market. Like, I don't think it's a bear market, dude. I think we still have the Fed going to cut rates. I know that typically that sometimes signals the top, but seasonality wise, during an election year and a strong first half of the year, I'm going on history, I'm going on probabilities. We tend to maintain that momentum. And so to me, this is a pullback. I, of course, want to see good stabilization here and not just see a falling knife. But if we stabilize and start to head back higher, sure. I mean, to me, Frank, this is a pullback area that if we pull back here, there's room to get back to the highs. My concern would be if we keep stumbling and we test these April lows, that to me is a way more ominous sign for a bigger sell-off. That makes sense? Like,
Yeah,
I'm not
I
really
think
bearish until we take out April lows. Otherwise, this is a pullback that needs to stabilize, and then we'll see how this market can justify getting back to highs again.
I think if you look at the NAS on the monthly chart,
Okay.
it's gonna have to close a good bit higher to look, not bearish anymore. Because this, when you usually see a reversal or an inverted hammer pattern,
Yeah,
it's a sign of a potential reversal.
sure.
So if it doesn't do that, but even if it comes up and gives us like a pin bar or what do you call it, a morning star, something like that.
Well, so you're
Um,
saying this, if the red candle, so if it's right now, let me just draw this out. So if we had this larger wick, a little bit of body, so what you're saying is if this by the end of this month, if this pulls away and does something like this, something like that, if the body of the candle all of a sudden retreats and we have more
yeah,
bullishness to close out the month.
if we go back to break even, it won't look as bullish, but still that could still be a sign of reversal.
Yeah.
If it comes back up and is higher than last month's open, because they're right next to each other right now.
Yep.
Both months opens. If we can get a close higher, I think that would sort of indicate that we got, I guess, more room to run. But if it closes like that, or either of those two patterns or forms, however you want to call it,
Uh-huh.
I just think that that could be a sign for a much larger move lower. And that doesn't necessarily mean August is going to be red. We could see some green in August, and then September comes around, and if we don't get back to the all-time highs again or break higher, then
Right.
it's not going to look very bullish in my opinion. So I think we could see maybe some sort of bounce here if we don't continue lower. And if it does, I'm not necessarily bullish on this either because even with yields falling, the market's falling. Um, and we all are expecting at least one cut this year, yet it's not necessarily, you know, being a bullish catalyst right now.
Speaking of yields, 4.22 on the 10-year and 4.22 compared to 4.40. So we've squeezed out another, 5 or 10 basis points difference. So we're inside of like 0.2% now. I put a chart together. Here we go. I put a chart together this week. Oops, don't. I want to just open this one up. So new chart, load layout, credit spreads, AAA to triple C. I will be watching to see if these spreads get really, really wide. So 5.84 on the DBAA, which is a BAA corporate bond yield, and then you compare that to the U.S. 10-year compared to the one of these is the AAA. Which one is this? This one is the triple C. I want to move this one lower. So we've got AAA, triple B, triple C, and there's certainly a widening, right? I mean, the one thing I'm looking at is if you scroll back here, look at this is a daily time frame. What I'm looking for is just in price, or just I guess tracking as these are percentages. So looking for this. Look at how in 2020 spiked up, spiked up, spiked up. Your 10-year was heading down before it sharpened like crazy. But I'm looking to see, how up and up and up and up do these get. Like when these get wider, that's where if the show this week with Boris and Nick on the trading battle, we talked about widening credit spreads. They're still relatively contained, but that's the biggest fear moving forward is that every major crisis we've seen in the last 25 years with the dot-com bubble as well as a great financial crisis and even COVID, they quickly went into like some type of liquidity and credit crisis, which from top down just spreads everywhere and it's like a plague. And I mean, it is like a virus in the markets where there's nothing good that comes from deep widening credit spreads with liquidity concerns, and that's one of the Fed's also mandates is price stability. So anyway, I just thought this is something I want to watch. You hear a lot of people on the news talking about credit spreads. Well, we think of credit spreads like options trading. I trade a lot of credit spreads, but when they talk about credit spreads as far as high yield versus treasuries versus junk bonds, it's something like this. You got to watch and see, are these widening? And if so, that's usually a good indicator to point towards some rough patches ahead.
So
Also,
I have a question.
Yeah, go ahead.
about yields. If
Okay.
if we see one cut this year,
Uh-huh.
what would the shorter term yields do? Like what would they tend to do in that situation? Would they move harder than say the 10 or 20-year bond yield?
No, because when you have when you have interest rate changes, when you have ups in interest rates or downs in interest rates, the most affected bond yield is going to be the further out duration. So when the price sensitivity is going to be the farther out one. So your 10, your 20, or 30 years, those are going to be the most price sensitive to rate increases or rate cuts. So if rate cuts, look at the 10-year going down, look at the 20-year going down, and those going down, yields go up. The 3-month will probably stay pseudo steady, I think. But the 3-month, and we've talked about this a lot, like the 3-month versus the 10-year. Dude, the 10 years at 4.22, the 3-month is at 5.30. So the argument this year has been that the 10-year is going to have to get more aggressive and actually steepen before it goes back to normal, right? Because
Right.
the 3-month is probably not going to change, not that much. It's not that sensitive to interest rates like the longer term is. So that's one thing that's really crazy is we're like 0.9%. We're almost 1% inverted between the 3-month and the 10-year. That's crazy. And so that's been the concern, is that the 10-year is going to get steeper and steeper and steeper and get closer to 5%. And that does not bode well for equities. In fact, if you look at that 10-year, that 10-year was up to 5% when we actually, had all the pain in the market in 2023. That pullback we had from summer 2023 into October, November, that was all based on this. I mean, I'm not saying that's the perfect correlation, but we had that downward move in the market, and we had yields going up. And as soon as that 5% was hit, that was an interesting peak here on the 10-year. So
Yeah.
I don't think that the 10-year necessarily goes higher, but if we do, I mean, the 10-year above 5% is usually a problem, because that is, hey, look, it's not worth taking on the risk of being in equities and having the market tank the way that it could be tanking, but instead go more risk-free, park something for 10 years, grab a 5% yield, grab it risk-free. And then of course, fingers crossed that the US government's good for it, which some people would argue that it is or is not, who knows.
Hmm.
But does that
Interesting.
answer the question as far as which one is affected the most?
Yeah.
Okay.
So I wasn't sure which time, or I guess the time range was more sensitive. So I didn't know if 3-month would move quicker or the 10-year.
Yeah.
But
Longer time frame
yeah,
will move faster. It's
because
way
we've
more
had
sensitive to
that.
changes.
I think this is the longest in history we've seen the yield curve inverted.
I believe that's correct. Which is also why it's something that has to be on everybody's radar, because it's like an unknown. It's like, we've been inverted this long. Some have argued that it doesn't really matter. The inverted yield curve recession indicator's broken. I don't buy that for a second. That would be like saying that, there's no such thing as value in tech, and there's no such thing as large cap, small cap. It's like all these things that have been kind of tried and true in the market. Look, it might take longer. It might be a little bit more extreme, but these markets have a way of finding that correlation that's been pretty steady for 50, 60, 70 years. So I don't know what happens when we come out of that inverted yield curve, but I would imagine that it probably can't be great. If I'm going to put a probability on it, last time we did it in 2020, last time we did it in 2008, last time we did it 2000, none of those, to my knowledge, were good times, right? So I can't
Yeah.
imagine that coming out of it again is going to be like, oh my gosh, look at this, we totally went up a ton. I doubt it. I mean, we've had a good run. I think a lot of people didn't expect all-time highs through 2022, right? I mean, 2022 was ugly. Nobody expected all-time highs like we had in 2020 and 2021. So the market does irrational things, and all we can do is, manage accordingly, make sure we're never over risking, make sure we're diversified. That's all we can do. That's what we can control, and that's where your emotions are in check. It's like, do what you can control, just keep trading, and everything's fine. So yeah, but
Yeah.
I don't imagine a coming out of the inverted yield curve will be good. And on top of that, did you happen to read that that Morningstar article that I sent you and Nick this week?
I didn't read it.
You didn't read it. Are you not a reader?
I was
I'm
busy
kidding.
yesterday. I'll
Oh,
read it
busy.
today.
Okay, sure. Well, how about I just show it? Let's talk about it. So really quickly, we can just gloss over this. I just thought there's some really good takeaways, right? This was in June of 2024, but just talking about top indicators of recession. things like this are happening. Rising inflation, well, that's kind of squashed now. So that's not necessarily happening. Stock market declines, that is happening. Credit spreads, this is why we're watching them. Inverted yield curve, this is why we're watching it. Decrease in GDP. We've had stagnant GDP, but today was slightly better. So that's like a mix. High unemployment, we are creeping up. 0.5, 0.6, 0.7% unemployment increase. So that's happening. Business spending, scaling back, right? If businesses are scaling back or trying to go more AI, more automation, cut back. You know, if it's declined, usually that's not a good thing. Price of gold, gold's up. Okay, new housing starts, home prices, they're down. So a lot of these things here are typical indicators of recession, and we're checking a lot of these boxes. So food for thought. Where do they point today? Market expansion, we're expecting a slowdown. Interest rate volatility, it's been all over the place. Likely the overall rates will come down slightly. That restrictive nature will come down a little bit. Inverted yield curve, crazy, right? There have been no signs of recession since we inverted in 2022, but as we've seen in the past, coming out of that inversion, this is average spread of 1%. So this is where we need to watch. There's your inversion, is that black line. So when we were down here, okay, and did we have a crisis in the 70s? Yeah, that was your inflation crisis, right? 87 crash, or just after the 87 crash, not great. 2000, we know what happened. 2008, we know what happened. And now, question mark.
Well, this is the 2-year and the 10-year.
This is the 2 and the 10-year, but so it doesn't matter. Like the common inverted yield curve barometer has been the 10 and the 2. But the 3-month and the 10, the reason I like the 3-month and the 10-year is because that's been undefeated with calling recessions. When those have been inverted, we have a recession. So I don't know. I mean, if it started in 2022 and here it is 2024, 3-month and 10-year inverted, 10-year and 2-year inverted, what happens when we come out of it? I can't imagine it's going to be great. So
I don't think
to
so
that
either.
point, I almost wonder if this thing stays inverted longer. If this market's going to have more upside, I would imagine that we stay inverted longer. And I don't know how that's necessarily possible, but I do know that the Fed rate is coming down. And so if the Fed rate's coming down, that will bring the 10-year yield down, which will bring 10-year yield or 10-year bonds up. That'll bring the 20-year down, which will bring yields or bonds up. And so I don't know, because the way that we're doing these auctions every 2 to 4 weeks for treasuries, I mean, maybe the 3-month is going to stay, but the Fed's rate overall is cutting. And I mean, dude, I'm not in the Fed, right? Like I'm not this master economist, and I don't pretend to know, but I just have a hunch that this can't end well, or this can't be like this forever. So at some point, I think there's going to be there's going to be a reality check, more so than what we saw in 2022, and maybe not something that could be saved by the Mag 7 or something that could be saved by the Fed and a backstop. And
So
that's
are you
ultimately
bullish or bearish? Because you talk about markets trending upwards, or at least earlier on, and then you say that we're in for something that's worse than 2022. So where are you trying to go here?
So I would
the
say
market?
that for 2024, we have fiscal spending that will continue. We have an election that, for better for worse, I think fiscal spending will still stay consistent. Whether it's policies going towards social reform or policies going towards fiscal reform, or like corporate tax breaks and things like that. I mean, whatever. We'll put a question mark around the election because who's going to win? Who knows? What else? We've got the Fed cutting rates. Okay, we have earnings. Are they good enough? Right? I mean, we're not sitting at like 28, 29 multiples on the price to sales ratios. We're not sitting at crazy, ridiculous, like crisis multiples like we had in the past. We're sitting at rich valuations. We're sitting at, 24, 25. But like 28, 29, 30, those have been the extremes. So if earnings are good enough, what's the forward guidance? I mean, right now we're noticing that a lot of the talk is about the consumer cutting back. Okay, well, consumer cutting back equals smarter consumer, right? I mean, what consumer right now is going to be like carrying $20,000 of credit card debt? That is ridiculous and the worst possible debt you can carry. Now, if it's a consumer that has student loan debt, if it's a consumer that has a mortgage, I mean, most people right now are sitting in this insulated household equity because for the last 4 or 5 years, prices have gone up 25, 50 to 100% in value. So on paper, the consumer is actually okay. But what the consumer is doing is just stop spending, scale back. It's fine. Stop buying crap. Go on a vacation, sure, but stop buying stuff. So that's what we're scaling back on. People are upset about the grocery store, whatever. But point is, consumer is okay. They're okay. It doesn't feel like it. I know it's painful out there. I know stuff is way more expensive than what they make it seem like. 3% inflation. It's, the eggs and milk and some of the grocery store and gas. Yeah, I get it. It's like 20% more. Okay.
Yeah.
But if we're cutting back, it's like this is where the slowdown happens. Our GDP is 70% consumer based, right? So if the consumer scales back, that means a likely slowdown for the US as far as consumption. But can the US still produce growth elsewhere? Maybe in tech, maybe in margins. As yields come down, businesses are able to refinance, restructure. The housing market, corporate, or I should say like institutional housing or corporate housing as well as residential, cuts make a big difference, man. Make all the difference in the world. And on this chart, this article here, the one thing that I really took away from this is look at our GDP. So inflation rate coming down, low 2s or sub 2%, and then real GDP growth just above that. Projecting that we have a 30-year mortgage by the end of 2025 falling into like the 5% range. And then by the time we get into like 26 and 27, we're at 4%. Okay, I mean, if you're willing to wait for a little bit, but the problem is you wait for 4 years to get rates down to 4%, your house prices are probably going to stay where they are now or go slightly higher. I would assume prices are going to stay stable or go higher depending on the market, but 30-year mortgage is slightly higher than the 10-year treasury, which is anticipated to be right around 3%. Okay, federal funds rate will be slightly below that, around 2.5% or 2%. So the direction of all this is my point here. The direction of all this is things are coming down. This is why I keep saying that a cut by the Fed is a consumer-friendly cut. Okay, I don't know if jobs market's going to change much. I mean, we've had a softening. Do rate cuts help jobs? I don't know. Maybe.
I mean, it's a nice
Probably not.
gesture. Like
What's
a
that?
25-point cut, basis point cut is a nice gesture, but is that even enough?
No, it's definitely not enough, but it's the gesture is this is what is coming, right? And this is what the market does all the time. The market is forward thinking. So for a gesture of 25 basis points, that means another 100 basis points is coming. The market gets a little bit more amped up and excited about that. Now, to this point, we've seen the market amped up all year, right? Fed's going to cut 7 times. Market rips like crazy. One of the craziest Q4s we've ever seen since ever. And we still have maintained that momentum. That's what's crazy to me is like with 7 cuts, then to 6 cuts, then to 0 cuts, then to 1 cut, then to 2 cuts. I mean, this market's like, we don't care. Rate cuts are coming. Things are fine. And it goes, and it's got blinders on. So I think that's been the scary part is we're overstretching. We have this super, super narrow market. And right now, here's where I think this is my summary of today. We're getting a pullback right now. Okay. This is the chance for the market to stabilize as a whole and see if we can get a broader market recovery. Not a narrow-led Mag 7 rally, even though that's what happened in April and May. But could it be led by Mag 7? Sure. Could it be led by overall consensus being positive for earnings? Sure. But to me, after this pullback that we're seeing right now on these indexes, S&P and Qs, okay, we're actually green on the day today, which is kind of nice. It's a lot of volatility today, man. 5-4. I'm looking at the SPY. It was down $2.50 and then ripped up about $5. That's a lot. Anyway, this pullback, I think, gives the market a chance to say, okay, pullback happened, pullback acknowledged. Now the SPYs and the Qs, if they're going to stabilize, can they go up along with the Dow and the Russell? Because what's been the missing ingredient all year, Frank? Not everything's been moving together, dude.
The small caps.
Yeah, well, no, I mean, the Dow has not moved into conjunction with the SPY and the Qs. This year, it's been like this. SPYs and Qs. Okay, so we'll say SPY is here. SPY is there. Qs are there, right? Dow, little pop there. Russell, little pop there. It's not the same. And so as a healthy bull market, this is not normal, okay? But when you put it all together and you take this environment we're in right now, is this enough to say, okay, we shed a little bit here, we stabilize. If this is going to go up, does everything follow suit? Can we have a SPY Qs recovery here, and can we have the diamonds and the IWM small caps, can we have them also go with it at the same time? And
Well,
so
the
maybe
Russell is very you know, it's been lagging all year, but it's the only one of the only things up today. Dow is
I
barely up,
know, I know.
but I can't. If the whole market's coming down, it's gonna be hard to go against you know, the overall momentum.
Of
But
course.
I did sell a lot of my small caps, so
Okay.
we are just kind of sitting and waiting.
Yeah.
But yeah,
Okay.
you
Well,
know, we're over time again.
I'll fudge. All right. I was hoping we go for another few minutes. No, it's okay. Yeah. All I was gonna say on that with we talk about this later. I'll just we'll talk more about like ways to position. So quick, and I'll let is it James or Nick that comes on, or is it Nick Phillips who's coming on?
Yes.
Nick. Okay. Um, if I put on a trade like this, bear put spread and a naked put, and I have a trap. That's one of my favorite trades where I collect credit. I've got a long trap, and then there's my risk. Because if we're here, we go down a decent amount, down even a lot, it actually gets me into a 10x profit, and then this is like a 95% probability of profit. I start with like extremely high probability trades, but it's something I have to manage, you know. And anyway, there's ways to trade like the down market. There's ways to hedge and still like, look, I could be wrong on the downside and I could be this perma bear, but it is stupid to be a perma bear and watch this market melt up against you and just still justify a bear market. It drives me crazy when I know people out there are bear, and they could be wrong for years and years and losing their shirt, and all of a sudden they get 1 6-month window, 12-month window right, and they're like, "See, I told you." But did they make money for the 3 or 4 years that they were shouting that the sky's falling? So I just think trade what you see, use good risk management. There's so many strategies out there to make you money. So anyway, that's it.
Yeah.
That's my time.
Well, you got your few minutes.
I got my few
We
minutes.
gotta
Thanks.
go.
All right. Thanks, Frank.
Yep.
All right. See
Thank
you.
you. Bye.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show.
What is going on, everybody? Happy Thursday. Happy to be here today. If you guys have any questions for me during my stream, I'll be on for about the next 20 to 30 minutes. Go ahead and feel free to drop them in the chat, and I will try to get to them. So this morning we had GDP, jobless claims, and PCE prices drop. And I want to take a look at what all of this how this all came out in my perspective of what it means for the markets. So advanced GDP came out pretty hot this morning compared to prior and expectations. Actually, I like this chart a little bit more. Boom. This is a little bit cleaner for me. So, 3 year. As far as GDP is concerned, coming out hot, it is still cooler relative to almost a year ago. So, exactly a year ago, we're kind of flat, 2.8 compared to 2.1, but compared to Q3 of 2023, we are down significantly still from this 4.9 area, 3.4, 1.4, kind of just a little bit of a slight bump back up here. So we're seeing some growth in Q2 anyways. Now, pair that with something like the initial jobless claims, and we still have, even though this was cooler than expected, we are still up relative to, let's go, we'll go from January of this year. We're still pretty hot as far as jobless claims are concerned comparatively to the beginning of this year. Let's find where did January started. So January started 198,000 jobless claims, and now we're averaging 235, 243. We're hanging out 240s, 230s. So we're up pretty significantly from the beginning of this year on initial jobless claims. And if we check out continued claims, we're also up. Let's see, January. Boom. So 1.85 million, I believe, is what this is supposed to be. Yes, million. Okay, so I don't know why they list it like this on Trading Economics. K thousand, 186 K thousand. It's like thousand. Just say million. So we're up on jobless claims, but growth is continuing up. So our labor market is not starting to, but over this year it is. This year it has started to slow. It has started to contract a bit. GDP is up as of Q2 of this year. Inflation has started to come down in the last month, not month, sorry, the last 3 months. So a little bit of softening in the economy with growth. This is sort of, I believe, the ideal scenario. Let me check one thing real quick. I don't have it pulled up on this computer. You know what? I think PCE prices might have messed us up for the Goldilocks. PCE prices. Yes, so PCE prices messed us up on a Goldilocks print. Yeah. It's the state of the US economy is interesting right now. My oh, too many tabs. Yeah. About every 2 or 3 weeks, somebody said too much tabs, my PC would have blown up. Every couple weeks I have to like close out my entire Chrome because I open tab after tab after tab after tab and then forget to go back and close them once I'm done. I just continue to open new tabs. But my outlook on something like the dollar, for instance, it's tough because we're getting some overall softening in economic data. But we have this looming Trump trade based on the markets sort of starting to anticipate and expect a Trump victory in November. And with his proposed economic policies, uh, potentially bringing about an inflationary environment in the economy. He wants to do rate cuts. That's one of his, big things. He wants to cut rates, wants to make it easier for, consumers to access capital. But on the flip side of that, he wants to impose tariffs that could theoretically hurt us price wise here in the United States and see inflation continue to rise like it has over the last few years. I know inflation is down on the year, but if you back out, let's go CPI real quick. Back out farther than a year. We'll go core inflation year over year. So this time to last year, it was 3.3% up. I wish I could see what would be core consumer prices. So prices in the last 5 years have just continued to absolutely, I mean, it's ridiculous. It's absolutely insane. On the consumer side of things, I think people get confused when they hear something like inflation is at core inflation is at 3.3 or inflation is at 3.3%. That's from this time last year. I would be interested if anybody knows where I can find this information, how I can find a chart for this. I would like to compare this year's numbers to the year before last and the year before that. So not where is inflation at now relative to last year, but where is inflation at now relative to 2 years ago, to 3 years ago, to 5 years ago. I believe that we are still incredibly hot inflation wise if you compare it to 2 years ago. All that being said, the good thing about this dollar conundrum from my point of view is the way that I trade is based off of red folder economic data. So typically what I've been looking for is reasons to sell the dollar. I've been looking for data to come out to give me the opportunity to get in bearish on the dollar, which means when we have hotter prints that would push the dollar up, I have less conviction to trade those prints. Simply because my overall bias is the market wants to see reasons for rate cuts this year. If we can get those, cool. I anticipate the market to start pricing that in. If we don't get those, I don't have as much conviction to think that the market is going to price in rate hikes. So to push the dollar up significantly, I'm not as convinced on hot data, hot US data. Now, with the market being where it's at right now, with the doxy bias sort of being neutralized, right? We have softening economic data. We have the potential Trump victory pushing US up. We've essentially neutralized any bias either way for the dollar, theoretically. So for me, I don't mind taking a trade on dollar pairs if we get bullish data or if we get bearish data, hawkish or dovish data, data that points towards dollar strength or data that points towards dollar weakness. That is the only benefit for me right now of sort of this neutralized situation that I find myself in when it comes to the dollar. Now, let's change gears here and look at something in Q. NQ rallying a bit, I believe, this morning, maybe off the PCE prices. This drop makes much more sense to me than this recovered rally that we're seeing in the last hour and 10 minutes. Now, I will say I wouldn't expect this to last. My expectation for something like the NASDAQ right now, here's why I wouldn't expect it to last. I'll switch gears over here, go to the 10-minute chart here real quick. Since July 11th, when we got CPI data, every time the NQ has attempted to rally, it's failed. Attempted to rally, 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 failed. Every attempted rally has failed since the CPI print. So, what does this mean for us? This to me indicates a bit of a bearish market has taken hold of at least NASDAQ. I'd have to go look at S&P 500 to confirm that it's also on happening over there. I pay attention more to the NASDAQ than I do the SPX. But this has just been a massive move to the downside. Yesterday, I believe it was, NASDAQ saw its biggest losing day since December of 2022 or October of 2022. So almost 2 years, a year and a half worth of price action. Yesterday, we saw the biggest red day out of the NASDAQ and the S&P since 2022. That is pretty massive. Now, the other day when I was on live on Tuesday, I believe, I was saying that if we don't push up from this level, my expectation was if we fail to push up from this level, we would see price come back into this area and then beyond this start targeting some of these other key levels. Now we've seen the NASDAQ tap into this 1900 area, and I believe this is a huge psychological level. Not 1900, 19,000. This has got to be a huge psychological level. It's around $1,000 level. I'm not surprised actually to see this reaction now that I'm looking at it from a technical basis. This is where the question comes in. Are investors going to be buying the dip right here? Or are they going to be waiting for the dip to dip further back down into this 17 to 1800 range? For me personally, I'm not looking to get involved in the NQ long until we see a significant shift in the daily. Now, a couple things that I would anticipate happening. One, if the bulls are going to take back control of the market from this point on, I think it would be a nasty move back to the upside. I would not anticipate a slow burn back to the upside from here. I would expect a slow burn to the upside from these levels. And here's why. If we're thinking price action wise, standard, just market reactions, I could see a continuation into this area. Make a lot of retail traders think that we're going to come in and do a bit of an inside retest, create this head and shoulders pattern, fall to the downside, and then slowly eat away their positions back to the upside. I could see that happening. Not taking fundamentals into account at all. Vice versa, technically, I can see yesterday being this entire leg acting as a bit of a bear trap, right? So you heard me say at the beginning of talking about NQ, I believe we're in bearish structure now. So there's a lot of retail that probably is thinking the same thing. We're in bearish structure now. Sell, 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 sell. Boom. And the market gets bought back up and all the sellers are being taken out of the market. For me personally, I would not be trading this up from here. I'm not interested in trading it up from here. I would just be looking for reasons to continue to sell off the NQ. So that's going to look like tomorrow with consumer spending. Cooler consumer spending. I'm not really sure how consumer spending is going to tie into NQ tomorrow, to be honest. Let's move on because I don't have a real good footing on NQ at this point in time. My main bias coming into this was if we fail to push up from this support level, we would tap back down into this area. Now we're in this area. It's anybody's guess as to how price is going to react from this level. So, all right, let's see. Gold 2350. Somebody said gold 2350, good TP. I mean, you're right there. I'm assuming you're scalping this. Not really sure where you may have gotten in. Yeah, for sure. So we had good reason this morning. If you're just considering the GDP, the advanced GDP numbers, which I think was the most impactful when it came to as soon as the data came out, market reactions. We saw dollar pop to the upside, gold obviously pop to the downside. Um, let's check it out on a 1 minute basis. So this is where, right here is where GDP data dropped. And for the next hour afterwards, we saw bullish price action out of the dollar. My personal opinion on this is that the Doxy strength and the gold weakness, it's tough. It's tough because of the macro environment right now, because of the softening economic data, but the proposed situation from Trump. Fundamentally, it's hard to identify a bias for me personally. But on a technical only basis, not a good entry point for me. Not somewhere I'd be interested in getting in for gold. But I could see bearish downside to these lows, and then beyond that, it's sort of anybody's guess as far as, are we going to find support here? Are we going to rally back to the upside? What's going to happen fundamentally? Um, I wouldn't say I'm a short-term gold bear at this point. We have a bit of a channel here. Oh, so 2350 is not a bad target if you're scalping it down to the to this area. You're sort of meeting um, you're meeting some support from within this channel, and you're meeting, depending on how long it takes to get there, sort of meeting the this channel, the bottom trend line of the channel. Like I said, I'm not a gold bear at this point in the game. I think we still have a lot of room to the upside for gold. And if I think from a risk sentiment situation, I see more gold upside. The uncertainty that, thanks, where can I follow you? First time here, respect from the Netherlands. At official Nick Phillips on Instagram, it's Nick Phillips on Twitter or X, at official Nick Phillips on YouTube, but just official Nick Phillips. You can find me. If you hit my Instagram up, you'll find me there. But yeah, long term, I would say I'm still a gold bear, or sorry, still a gold bull. And part of my reasoning is the uncertainty. A big part of my reasoning being the uncertainty with the election coming up in the U.S. There's a palpable tension here in the air where it feels like at any moment something new and crazy could happen in this election cycle. We have an attempted assassination of the president, 2 weeks ago, the former president 2 weeks ago. We have the current sitting president backing out a very unpopular VP, now being the nominee for the Democratic Party. It's anybody's ball game right now. Election cycle, trading through this election cycle is very yeah, Trump winning for sure. I look, political opinions aside, I'm certainly not somebody who, like, I don't go crazy for politicians. I think it looks when it was Trump and Joe Biden following the debate and the assassination attempt, it was a Trump shutout, in my opinion. And looking at some polls, his victory seemed almost assured. Now with uh, Vice President Harris having her hat in the ring, I don't want to say she can't beat him, but she's a stronger opponent than Joe. Yes, I think it's a tougher fight than Joe, but I still don't know if it's enough for her to win. So with that being said, an inflationary scenario in the U.S. economy coming from a Trump victory, gold is supposed to be a hedge against inflation expectations. There are some charts that show whether or not that always is the case. But if that's the case, a Trump victory could see us having gold and U.S. dollar upside at the same time. So yeah, it's a very, very interesting time to be trying to formulate biases. And I guess I would say I am not. I guess I would say I am data dependent when it comes to pretty much everything that I look at, which is currencies. I look at gold. I watch gold. I don't necessarily trade it a lot. Um, Mainly currencies and a little bit of the equities. So when it comes to the dollar itself, I'm entirely data dependent and just taking my viewpoint of the dollar, economic data by economic data, headline by headline. Right now, this is an interesting fundamental experience because it feels like there's no real way to grip a bias, whereas over the last, let's see, I started implementing fundamentals into my trading last summer. So in the last year, I feel like I've always had a hand on the wheel as far as an overall bias when it comes to the dollar. But right now I don't have a hand on the wheel because it's not that I don't have a hand on the wheel. I guess my hand on the wheel is neutral. It's hard to create a bias either way. So it's a very interesting time for me fundamentally trying to carve out a bias here for the dollar. Um, what sites do I watch? That's a loaded question. I will say one of the biggest sources for me right now is Twitter. Twitter is a huge resource for fundamentals. Um, Once you can find some people on here, market analysts that have, I mean, they go like they're similar to Chris Pulver. Like they go into some of these charts and discern signals from the most obscure pieces of economic data to where, like, for me, it can be a little bit too in depth. I like to keep my trading simple. So when it comes to, like, I have two boxes of thought, right? Tradable, actionable information and information that sort of just is nice to know. It's how can I say this? Peripheral information. It's good to know, not really necessary for how I trade. But to answer your question, X is a good one. Financial Juice is a good one for headlines, and I like the way that for data, like I can input alerts here, and when if core PCE prices comes out higher than this, it's going to give me a buy button. If it comes out lower than this, it's going to give me a sell button. And then if all of these come out in one direction or the other, it does the work for me of having to try to remember what numbers I wanted to see in order to get involved in the market. So Financial Juice is a great one. And they also have these articles that they do, these daily prep articles where you can go through and read through sentiment, et cetera, et cetera. And then Forex Live, again, another good resource for me. I like to read through some of these things and see what people are saying. But even them, let's see right here. They quoted Nick. I cannot say this guy's last name, Timoros, but they referenced his X post, his tweets, right? Um, so even these guys that are writing up stories are getting their information from X. So, again, I don't like to take sides politically or anything like that and say like, oh, rah rah re like I'm for this person or that person. So I'm not gonna all that aside, X is proving to be a front runner when it comes to economic any kind of news. I found out about the Trump assassination attempt on X. I found out about Joe Biden dropping out of the race on X. I found out about Kamala Harris being the new nominee on X. I find a lot of my data on X. The thing is, you have to start to you have to look for this stuff. So, go to Trader Nick, go to Chris Pulver's page, go to start looking at Financial Juice's page, start just look up like Forex macros, and you'll start to find all sorts of tweets and people, and you can go to my page and follow the people that I follow. Uh, Profile. So like 90% of these people are market analysts that, they post really good information. Another good resource is Substack. Shameless plug. This is my Substack, official Nick Phillips. But some of the people that I'm subscribed to on here, let's see, like Capital Flows. This dude has, again, some of these guys go into some of these charts that are absolutely insane. Have I marked up gold yet? No, but I can go back and touch on it again. I didn't mark it up per se. I gave like my overall bias for gold is I'm still a gold bull. I haven't switched my hat to gold bear yet, but that's on a longer term basis. On a short term basis, I would say I could see us tapping down into this area here, 2300 ish, lower 2300s, or right at 2300, I should say, as opposed to 23.5. But I don't, yeah, I'm not interested in getting involved in gold in this area, sort of in the middle of this range. Like we're almost smack dab in the middle of this thing. We'll take it to the top of the range. We're like kind of around 50%, 61%. So yeah, not interested in trading it in either direction out of this area. But yeah, Substack Capital Flows is great. It's a lot of reading. That's what fundamentals has boiled down to for me, is just reading stuff from Goldman Sachs, from JP Morgan, from market analysts, YouTubers talking about this stuff. There's a show called Macro Mondays, I believe, on Spotify, and then PIQ Suite, which I could be completely messing up that name. I like these guys a lot. They do a morning show. It's called the Morning Blast. Every day, it's about 15 minutes, and they cover the latest happening. Like it's a daily refresh of what's going on in the market fundamentally, globally. So definitely, I would say this is one of my favorite uh, analyst resources. Would be the PIQ Morning Blast. Oh yeah, I've never tried. Somebody said I never tried Twitter for info. I would give it a shot. So I'll say this: Twitter for info, or X, whatever you want to call it, it is great. And one of the best things about it is some of this, like this Explorer. It says beta. Your Explore page, like once you start to kind of build out the algorithm starts to see that all you care about is macroeconomics. It's going to publish some incredible stories for you. So we can click here: market expectations of Fed September rate. anticipating a reduction of 0.5%, so 50 basis points by September. The expectation is fueled by economic indicators. But see, then you want to go, you don't just want to take this with, it says some investors anticipating a significant reduction of 50 basis points, right? Well, what is some investors? Quantify that for me. So how do I quantify that? I go to FedWatch and I go, okay, September, only about 14% of investors are pricing in 50 basis points in cuts. The rest of the market is only pricing in 25%. So, I mean, we're 100% priced in for cuts in September. There's 0% pricing in a pause. So our current levels is 5.25 to 5.5, and we are almost 94% priced in for a pause in July. In September, we are 100% priced in for a cut, with almost 86% of the pricing in being a 25 basis point cut, and the rest being a 50 basis point cut. Is that? Let me verify. Yes. Okay. Yeah. So you got to be a little careful and kind of verify some of this stuff. And then you can read through some of this. So Walter Bloomberg, I follow this guy. He does a lot of headlines. You can find headlines on Twitter really fast too. Who I wish this was a good time for headlines right now. Like I wish something was coming through because like PIQ does headlines. Let's go to X Pro real quick. If you sign up for X Pro, you can create like a tweet deck here, which if you hit me up on Instagram and you end up doing this, either hit me up on Instagram or Twitter and I'll share my tweet deck with you. I don't really know how to share it other than to do it individually. Capital Hungry is good. The only thing I'll say about Capital Hungry is they have a lot of very opinionated things that they print, which to me can be a little annoying. I'm very much like a data person. Give me the facts, give me the information. I could care less about people's opinions. The only time opinion really comes into play for me is when I'm thinking about like maybe risk sentiment. Then I want to gauge sort of what some of the analysts are feeling. But even then, that's, I guess, less so personal opinion and more so like the markets are starting to feel a little fearful, blah, blah, blah. So Financial Juice is a good one. Walter Bloomberg, First Squawk is on this list. Forex Live, New Squawk. I think that's really it. There's another one that's actually not on this list that has turned out to be really good. Let's just scroll through my following real quick. Let's go back to, what time is it? 11:42. I think I'm running past my time here. I'm going to try to. This is good. The Spectator Index. It's some of it's stuff that doesn't matter. Zero Hedge is a great resource for data. Oh, come on. Unusual Whales, another good resource. So yeah, definitely, I can't find the one that I was thinking about. And I know if I scroll back far enough to get to the 11:40, 9:40, it would have had to have been about 3 hours ago. If I scroll back to where GDP and PCE dropped, I know that they would be one of the first ones that dropped the data. But yeah, regardless, I don't know how to say this. Kobayashi, maybe Kobayashi. This is a great outlet as well, a great source of information. This, let's see, Open Source Intelligence Monitor. I like them for potential war escalation headlines. I tend to see stuff from them before I see something from pretty much any other news outlet. Now, if you've got the money, I'll be honest with you guys. If any of you guys that are watching this right now have about 20 to 30 grand a year that you can set aside, just getting a Reuters or a Bloomberg terminal, that's the name of the game. If you can get that, not that you don't need Twitter, but you kind of don't need Twitter. It would be kind of all inclusive. All the information that a lot of these guys that are posting on Twitter, they get a ton of their info from their Reuters and their Bloomberg terminals. But those things, from what I know, they cost anywhere from like 20 to 30 grand a year. So you're talking like 2 to 3 grand. Is that math right? Yeah, about $2,500 a month for a Reuters terminal, and I think that may be on the low end depending on the functionality. But if you guys have that, that would be, the number one. Michael Brown, he does. He's a co-host of the PIQ every day, or most days. But yeah, Twitter's great. I think that's it, guys. Like I said, neutral on the dollar, neutral on gold, data dependent, waiting for more data to hit the market. And my reasoning for it, I'll follow up with softening inflation data, little bit of some warmth coming, not warmth, but contracting job market. But we have the potential Trump trade pushing it up. So flatlined on the dollar. And I think that is it. If you guys have any questions, feel free to reach out to me. I try to get back to everybody as soon as possible. Usually within like 24 hours, I can get back in touch with you. But other than that, from all of us here at A1, I hope you guys have a great rest of your trading day. See ya.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.